you all for coming and joining us on this webinar. We have a fantastic speaker today, and Tom Clark. Tom, well, as you probably saw, the invitation has given more speeches on behalf of the Social Security Administration than anyone in the history of, I would say, the company of the administration. So he's a fantastic speaker. Every time we even host these, we get to get an update. So looking forward to it. And please raise questions. If you have a question, likely someone else has, and I'll have the answer, and it'll add additional color to the presentation. So thank you.
Thanks. And yes, Bill, I do want you to feel free to ask any questions. Sir, when I work for Security, most of the time I was a public affairs specialist, and doing presentations was a big part of that job. I'm making 6,000 presentations for Social Security. And then as baby boomers started reaching retirement age, there's a whole bunch of us, pretty much doubled Social Security's workload. And the staff is actually the lowest it's been since 1967 now. They didn't have the resources to keep doing these kind of presentations. Everybody needed to be in production. So they quit doing the presentations. I became eligible to retire right when that happened. So retired, just kept doing the same things as a self-employed person. I've done about another 1,000 presentations since then. So there's been 7,000 presentations. You're not going to make me lose my place. If you interrupt the question, I used to tell groups they would not ask me anything I hadn't heard before, but I found that some people accept that as a challenge. But you won't make me lose my place anyway. So make it a conversation, not a lecture. It's much more interesting for everybody. I usually don't use PowerPoint in these in-person presentations because I found it creates a barrier. People don't ask as many questions as they should. So it's make it a conversation, like I said. And of course, you're here for retirement planning. So I'll spend almost all my time on the retirement parts of the program. But I want to very briefly talk about the other parts of Social Security. Because almost all the time when people think about Social Security, all they think about are retirement benefits. Those retirement benefits are indispensable. We could not do without them in this country. But based on my 33 years working for the program, I can assure you those retirement benefits are by far the least important part of Social Security. We also pay survivors benefits and disability benefits. And most people are aware that Social Security insures us against loss of income due to premature death or disability. But most people don't know how important those benefits are. But as you just heard me say, I think they're far more important than retirement benefits for a lot of reasons. But the number one reason is human nature. We look forward to retirement. We make plans for retirement. I mean, you're doing this for that. Take a time out of your lives to travel across town, come here and make plans for retirement. So the fact that you're sitting in this room right now means you're good planners, because a lot of people should be here and aren't. So since you're good planners, I guess we can assume if the seminar had been advertised to you as a seminar on preparing to become disabled, you'd all be here right now, right? That's a human nature part of it. We don't think it's going to happen to us. We don't think we're going to become disabled or die before we reach retirement age. But that assumption turns out to be wrong for a shocking amount of people. 1 out of 3 workers, 1 out of 3 will either pass away or become so disabled they can't do any type of work at all before they reach retirement age. The great majority of those 1 out of 3 don't die before retirement age, which is the good news, but they become disabled before that age, which is much, much more expensive, which is the bad news. On those survivors' benefits, if a parent should die that's worked and paid into Social Security, they'll pay a check to each child until that child turns 18. This was an average group. There's many people here. There'd be 3 people in the room that either received those benefits when they were a child because their parent died, or received them for their own kids because their spouse died at a young age. And in the 33 years I spent working at Social Security, I saw a total of 0 families. I didn't see a single one. When that working parent passed away, they did not need that Social Security check to keep their house, to keep making those mortgage payments. Because nobody buys enough life insurance to replace the earnings they lose when those working parents were to pass away. Most people can afford that life insurance. And if people don't think they need to buy life insurance or not buy enough, they never think at all about disability insurance. We need that far, far worse for 2 reasons. First of all, we're 500% more likely to become disabled than we are to die before retirement age. And second, the most expensive thing a person can do in their lifetime is become disabled. If somebody becomes disabled, their paycheck stops, but their expenses skyrocket. Now, when Social Security says disabled, they really do mean disabled. For someone to receive disability and Social Security, they have to be so disabled, they can't do any type of job that people do for a living that exists anywhere in the 50 states. Medically, it's a very, very strict requirement to receive disability and Social Security. Unfortunately, a whole lot of people end up meeting that requirement. 25% of all workers will become that disabled and receive those benefits before they reach retirement age. 1 out of every 4 workers. And I spend a little more time on this than I used to because the world's changed in a lot of ways. One way it's changed is a lot of people find a different way to make a living that didn't exist when you and I are in the workforce. My youngest son is one of those. He's just a freelance writer. You think somebody wants written, he'll write. He gets assignments online, gets paid online. To me, that doesn't sound very secure. I told you, where you're living, there's begging people to go to work all over this town. It'd be a good time to find something more secure. He said, well, Dad, I've had to raise my rates 3 times just to keep my workload manageable. So I guess money-wise, he's doing pretty good, but he has absolutely no benefits. He became disabled, Social Security is the only call he'd have. And Social Security is not supposed to be your only income at disability or retirement. So I've encouraged him, and he did, to buy a disability policy. So if you have a child or grandchild, work in that gig economy, encourage them to protect themselves and their families by purchasing disability insurance. Because good times, bad times, it doesn't matter. The number one reason families fall into poverty permanently is the disability wage earner. It's almost the only reason families fall into poverty on a permanent basis is one of those working parents becomes disabled. So people say, well, it's not, you have a hard time getting people to buy disability insurance, don't you, as a planner? And once they buy, you have a hard time convincing them to keep paying those premiums, right? Because it's not cheap. But this is the thing, insurance that's cheap, insurance we probably never need, right? Because they're going to happen to us. Insurance we need is expensive. That's why auto insurance costs a whole lot of money in Houston because a lot of people have wrecks, right? Same thing. A lot of people come disabled. That's why it's not cheap. But what insurance you buy that helps you avoid almost the only reason families fall into poverty. So if you have a child or grandchild working that way in that gig economy, encourage them to protect their families and themselves. It's really insurance. I could tell you so many horror stories. Now I start with the gloomy side because I want to get your attention right away. Then I can see by your faces. The more cheerful side of all that is for 2/3 of us, we will reach retirement age without becoming disabled. We're all in that lucky 2/3 group, aren't we? Until we're not. That's what makes those parts programs so important. It's retirement benefits. Now, when we're talking about Social Security, that term, retirement benefits, is not just a generic term. It has a specific meaning. Retirement benefits at Social Security means a benefit we can receive based on our own work at a certain age, and that minimum age is 62. You have to be at least 62 to receive retirement benefits from Social Security. At 62, though, those benefits would be reduced a little bit for each month we're younger than our full retirement age. And I passed my handout out. If you look at my handout, you can see there's a chart there showing based on your year of birth what your full retirement age is. Most people I talk to these days at 67 because anybody born 1960 or later is 67. That law was passed in 1983 because people live alone, start living alone. Up to that was 65, but that law was passed to raise it gradually to 67 back in 1983. To give you an idea about why Congress raised that full retirement age, a few years ago, when I was still working for Social Security, I was up in Baltimore at their headquarters for a meeting. The actuaries of the program told me that they expect people born 1960 and later, people at 67 for the full retirement age, to live an average of almost 30 years after they start drawing Social Security retirement. Average almost 30 years. And a lot of the experts on aging are saying that we baby boomers will be the first generation to live on average more years in retirement than we spent working. Yay. and I believe it's probably true. That's probably true. And so that's the reason pensions disappear, right? Employers, big companies had pensions because the average person at that time drew a pension for 6, 7, 8, 9, 10 years and they died, right? Employers can't afford to have pension longer because they're paying those pensions for 30, 35 years. My mother's 94. She was, when my father retired, she was 53. She's still drawing that AT&T pension. That's 40 years. So that's why we don't have pensions any longer, or just can't afford it because we're just living so long. It's why it makes Social Security more important than it ever was. More important for future generations because nobody's gonna have a pension in the future, right? Fewer people have it now, it's gonna be nobody in the future. That's why Social Security is so much more important even than it used to be. Now, once you're retired, as I said, you can take benefits as early as age 62. They're reduced month by month. So the question is, if you're retired when you turn 62, should you go ahead and take those reduced benefits? Should you pass them up and wait and draw your full benefit at your full retirement age? Well, it's your decision, of course. I can give you the information you need to make an informed decision. First of all, it's a month by month reduction if you take the benefit before your full retirement age. Each month you're closer to the full retirement age when you start those checks, the check would be a little higher. If you begin your benefits when you're 62 years and 7 months old, that check would be a little higher for the rest of your life than it would have been had you started the month before. So it's a month by month reduction. If you start exactly the month you turn 62, that point you would receive between 70 and 75% of what you would have received had you waited until your full retirement age. The exact percentage you'd get, start exactly the month you turn 62, depends on where you fall on this chart, what your full retirement age is. So if you are retired at 62 or before full retirement age, you have that decision. Should you take those benefits then? Should you pass them up and wait till your full retirement age? Well, if you are retired before full retirement age, you decide, no, I'm going to pass those checks up and wait till full retirement age, you would have a bigger check each month for the rest of your life, but you would have passed up all those checks you could have received in exchange for that higher monthly check. With that higher check you get by waiting, it would take you about 12 years receiving that higher check to recover the money you passed up. So in other words, if you take your reduced benefit, you're ahead 12 years past your full retirement age. That's a break even point. Now, I used to stop my explanation there until I found out that a lot of people were thinking I was saying you ought to take the reduced benefit. I thought I was saying the opposite. So I'll go a little further there. I know it sounds like a long time, 12 years to get your money back. When you're making that decision, keep in mind the average person is going to draw those benefits for a lot longer than 12 years. Think about it, it's a much different world than it used to be. When our grandparents were 70, they were really, really old at that age. Matter of fact, if you're a baby boomer like me, most of your grandparents didn't make those 70s, being the offset generation. Nowadays, somebody dies in their late 70s, we think they died young. It's a much different world. The reason it pays most people to wait as long as possible to start those checks is because when people start living longer, insurance companies can just change their tables anytime they choose, which they do all the time. That's why life insurance costs less now than it did 30 years ago. We're living longer. Social Security tables are based in law. It takes an act of Congress to change them, which they haven't touched other than raising full retirement age a little bit. And we're living longer than they thought we were going to at this point when they passed that law. Social Security started paying reduced benefits, which means benefits before full retirement age in 1958. So before 1958, you couldn't take a reduced benefit. You had to wait till 65, which is the full retirement age. So what that means is the reduction for taking the benefit early is based on how many more years the average 65-year-old lived in 1958. We're living a lot longer on average past 65 now than we did in 1958. If you hear the average person who lives the average lifespan, you will receive a whole lot more total dollars in your lifetime of waiting to full retirement age. And I do mean a whole lot more. A few years ago, a big insurance company hired me to develop a Social Security calculator for the financial planner class using their individual clients. And I don't own this calculator because they paid me to do it, but they let me use it anytime I want to. That's not necessarily altruistic on that insurance company's part. They're hoping if I'm using it on a regular basis, if the software guy does an update, it creates a glitch, then I'll find it before the clients do. That's happened a couple times. That's why they let me use it. But anyway, they let me use it. And I think I'm proud of it. It's a good calculator. One thing it does, it shows in today's dollars, not even counting cost of living raises, in today's dollars, how much benefits an individual and couple might receive in their lifetimes by taking benefits at different ages. And quite often, the difference between waiting until full retirement age, I think 62, means waiting until full retirement age that couple receive more than $100,000 more in Social Security lifetimes. So we're talking about a significant deal, significant deal to have in lifespan. Your decision though. Nobody's gonna, people do ask me all the time. They say, when's the best time for me to start taking those checks? Wanting me to make that decision for them. I thought about this a whole lot. I can still only come up with one way to answer that question. And that is, tell me the date you're going to die, and I'll tell you it's time to start taking those checks. Otherwise, my crystal ball doesn't work well enough to make that decision with somebody. But if you have some kind of inside information, and you know you like some people I used to visit back when I worked at Social Security. By the way, this is my best joke of the whole night. Never fails. I always bring food in right at my best stuff. I'm not gonna should have told you that beforehand. Anyway, if you're gonna be like some people I used to visit back when I worked at Social Security, you might want to wait and take that full benefit at your full retirement age. Social Security is a special project every couple of years. In this project, they go out and visit all the people over 100 years old who are receiving Social Security benefits. You might not think that would be a big project, but that is the fastest growing part of the population, people over 100 now. That's been for about the last 15 years. There's a purpose behind this project. This is a security audit. The reason they go see all the people over 100 in person is so they can verify that they are still alive. If they haven't died, somebody hid that fat and kept cashing the check. They don't tell them that's why they're out there talking to them. But I found a lot there on their own. I used to help a lot of the local offices in the DFW area. That's why I work with Social Security. Used to help a lot of the local offices in the DFW area with this project. You'd help with it. It's a big project. There are so many people over 100 now. A few years ago, they had to change the project. They can no longer go visit all the people over 100 anymore. There's way too many. So now when this project comes around, they just go see the ones they haven't seen yet. The ones who have turned 100 since the last time they did the project. Because just this year, just in 2026, just in Texas, more than 5,000 people will turn 100. That doesn't count the ones already over January 1st. That's 5,000 more turn 100 just in Texas in this 1 year. That's why they don't see those birthdays on the news much anymore. Because something that happens 15 times a day in the state, every day of the year, is no longer news. Not only are there a lot more of them, there are a whole lot going through good news to me. Of these 5,000 plus people that will turn 100 in Texas this year, the great majority are not in a nursing home. Most of them still live out in the community. Quite a few of them still live in their own homes, all by themselves, taking care of themselves. And I really do mean taking care of themselves. I've seen a few of these people actually more than 100 years old who drove to the house. 1 year, I had to go to a person's job site to find him. He was still working at it. Don't you about one lady people always find amusing. We visited her quite a few years back. We visited all people over 100. She was 103 years old. This time we went to see her. She lived all by herself in her own home on the west side of Fort Worth, which is the older part of town. She's just in great shape physically, really sharp mentally. As we were talking to her that day, she got curious. She said, well, who's the oldest person you have on your list? We looked and said, well, the oldest person in this area is a lady right here in Fort Worth. It's 108 years old. Well, this 103-year-old's reaction to that was 108. Wow, now that's old. So if you're going to be like her, that 108-year-old, you pay to wait for your time, your money ahead. Your choice when you think of the benefits. Or you might wait longer. Once a person reaches that full retirement age, there's no limit on their earnings. When somebody is younger than full retirement age, there's a limit how much they can make from working without affecting their benefits. But once they reach full retirement age, they can keep on working full time, receive their full benefits. But even then, some people don't take their checks in. Some people even wait till 70 to take those retirement benefits. Why do they do that? Because of something called delayed retirement credits. For each month from your full retirement age until 70, if you don't take a retirement benefit, when you do take that check, they'll add something extra called a delayed retirement credit. They add that for each month. You don't take a check between full retirement age and 70. Over 12 months, it totals 8%. So if you're full retirement age of 67, and you don't take those benefits till 70, 3 years later, the check will be 24% higher for the rest of your life. 8% for each of those 3 years. Don't delay past 70, because we quit that next year at 70, no matter what. Also, those delayed retirement benefits only apply to retirement benefits, which are benefits based on our own work. Delaying a spouse's or widow's benefit past full retirement age would not increase those. Just to make sure we're on the same page, let's say that the husband was the higher wage earner. He waited till 70 to take his retirement benefits. And because he waited till 70, let's say his check is $4,500 a month. As you'll see when we get to widow's benefits in a few minutes, if he passes away first, the widow does get that bigger check he got by waiting. So she does get those credits he got by waiting. But she reviewed that full $4,500 at her own full retirement age. That $4,500 would not go up if she delayed the widow benefits past her own full retirement age. So get the ones he earned, but the widow's benefit itself wouldn't go up by delaying past full retirement.
But she doesn't draw her, if she's working, she doesn't draw her benefits.
Technically, she draws hers and gets the difference, what gives that to it, but yeah, but as far as your point of view, she gets the one that pays her the most, yeah,
Okay.
as far as the amounts coming up. Before I go on to wives and husbands, widows, widowers, benefits, and on to Medicare after that. Hey, Paul, any questions, any other questions so far about retirement benefits before I move on to the spousal document? Yeah.
Can you comment on, came up the other day, Social Security having more money coming out and going in, and the confidence that we can have in the sustainability of the program?
Yeah, so I'll be glad to. Your grandchildren's Social Security. It's not an optional program, and I can show you real easy about that. But right now, I mean, it was planned all along for more money going out right now than coming in, because the Congress requires themselves to plan ahead for Social Security 75 years in the future. So when these baby boomers were very young, they started making plans ahead for our retirement. And the law, series of law passed in 1983 that brought in a whole lot of extra money into the Social Security Trust Fund. In the late 80s, the trust funds were running a $27 million an hour surplus. They're taking $27 million more an hour than they were spending, 24 hours a day. And that's resulted in, right now, we got almost a $3 trillion surplus in the trust fund. And that would have been plenty. It would have been fine, no change required, if we baby boomers were dying as soon as we thought we're going to. But we did. And so, since we're living longer than they thought, they need to make some changes. But that could be kind of pretty minor because that huge surplus that was built up. It's now being drawn down. That was the whole plan for that big surplus to be drawn down. But even if there was no surplus at all, I'd say Social Security is not going away because it's simply not optional. I think I can prove that to you because everywhere in this country, the largest source of income is Social Security benefits. Here in Texas alone, just in Texas, Social Security pays $7.5 billion a month in benefits. $7.5 billion a month Social Security pays in benefits. And almost every penny of that gets spent. Because if you're 80 years old, you're no longer saving for retirement. You spend that check that's coming next month and next month. Economists tell us the dollar spent and the economy turns over 7 times. So basically that means the Social Security accounts for about $50 billion a month in paychecks. Almost everybody's paycheck in the state. Can you imagine the depression if that went away? Back in 2008, 2009, economists started wondering, what was the difference between 2009 and 1929? Why in 1929 did we fall into a Great Depression, lasted 10 years? 2009, a very severe recession, but not a depression, and actually very short-lived, right? A couple of years, everything's coming back to normal. Well, there's a lot of differences, but a lot of economists concluded that the number one reason we didn't fall into another Great Depression in 2009 was because Social Security exists now and didn't exist in 1929. Because that $7.5 billion a month was still getting spent. In 2008, 2009, working people quit spending because they're afraid they'd be laid off next, right? But that people on Social Security still spending that check, and you don't get laid off on Social Security benefits. And that $7.5 billion a month still gets spent keeping all these restaurants and stores open. It's really the only reason we didn't fall into the Great Depression. So that's one reason why it can't go away. The other reason is the human cost. Because here in Texas, about 2 million people have virtually no other income but Social Security. So the checks didn't go out next month. We have additional 2,000 potentially homeless people just in this one state. But most of them, when we become homeless, hardly ever become homeless. So if you want to, you know why they wouldn't? Because they're moving you. Without Medicare, you'd pay all the hospital and doctor bills for the rest of your life. You'll never get to retire. Because I tell people, you say Social Security's gonna go away. I tell them, well, if Social Security's gonna go away, you better not downsize the retirement. Because you're gonna need one extra bedroom for mom and one for grandma. So it simply can't go away. And it's not gonna get cut 20% either. Now, they need to make some changes. Democracy is by far the best system of government, but it's not the most efficient system of government. And so when there's a crisis going to happen, it's got to be pretty close before Congress will make hard decisions. The hard decision probably this time is to raise taxes, okay? We're not close enough to a crisis to where they'll make that decision yet, but they will do it. They'll do it. They're not going to be cut either because a 20% cut in benefits, that would be $1.5 billion less benefits paid in this one state. That'd be $10 billion worth of monthly paychecks. That's not going to happen either.
So over the years, they've raised the full retirement age, but you were saying earlier that 62, the minimum wasn't always there.
No, you had to be 65.
Right. And then
When I could get
times they've always raised that. How come they've never done anything like that?
raising age 62, because that penalizes the people who make their living with manual labor, because their bodies are pretty much worn out by the time they're 62. And so that's why they didn't raise that. They wanted that option still for those folks.
I have a question on you. You're saying that we're gonna get Social Security benefits longer than we actually work.
Yeah.
So are people actually working longer, or are they stopping?
Well, there are a whole lot of people working longer. That's a big issue we talk about with Medicare, because that affects Medicare. But when I first started working Social Security, it was highly unusual somebody worked past 62.
Right.
Okay. Now it's highly unusual somebody retired before 65, and it's very common for people to work way past 65.
Right.
We're healthier and people are working longer. A whole lot of people are working.
But at that point, they've worked 40+ years.
Yeah.
So that puts them to where they, their expectation is to be well over.
Well, yeah. I think when the people were making that projection, they were kind of assuming people would retire at 65. When they were talking about that, they weren't looking at people that are actually working past 65. But yeah, you got a lot of people who are doing that. Now, they're kind of like me though, and maybe not doing the same kind. They're not working 40 hours a week, or they're not working for an employer any longer. They found those retirement gigs, but you got a lot of people still working their regular jobs past then too. And I think one reason they're doing that is because they realize how long they're likely to live now. When my father and mother retired, your parents too, it was an automatic. You took the benefits to 62. You didn't think about making past 62. If you retired at 62, you took them because they had no idea that they're going to live as long as they live. We know we don't have that excuse. We know how likely we're likely to live. My mother, 94 years old, went on a 3-week cruise around the UK a year and a half ago. She's doing great, but she never anticipated living to be 94. She's had diabetes for like 40 years. 94, living on her own, still doing great. So they had no idea that would happen to them, but we know it's going to happen to us. We need to make those kind of arrangements, make those kind of plans. And to me, the two biggest risks to a secure retirement are inflation risk and longevity risk. Inflation risk because even at moderate inflation of 3%, as long as we're likely to live, those checks didn't go up with inflation, they wouldn't be buying a whole lot by the time we passed it, right? But Social Security checks keep pace with inflation. It's the only guaranteed income that's going to keep pace with inflation. For me, it makes sense to maximize your only guaranteed income that's going to keep pace with inflation. And then a lot of people, now you have great financial planners, it won't happen to you, but for a lot of people, they're going to outlive their savings. And of course, your planner can't control everything it happens to, right? They can't control how much you spend. They also cannot control catastrophes. Things that unexpected cost a lot of money. It might not be one that happens to you, but one that happens to your child or grandchild. And all of a sudden they need hundreds of thousands of dollars for medical bills to keep them alive. And you're going to come up with it, right? And so longevity risk is you can outlive your savings even if you make all the great right plans. It can happen. And having that Social Security check keep pace with inflation is one of that because everybody gets the same percentage cost of increase. Inflation goes way up and way down, but it's always going to average 3%. Well, if you're a 3% raise on a $4,000 check is more dollars than you raise on a $3,000 check, right? And the next year, if you just raise on top of that, it's compound interest in your favor with that bigger check. By waiting till 70, say you have $1,000 more a month because you waited till 70. By the time you're in your late 80s, that $1,000 more is $1,800 more a month you bring in because you waited. By the time you're in your 90s, it's more than twice, it's more than $2,000 more. And so that's protection against both inflation risk and longevity risk by maximizing the check. Now, having said that, I don't necessarily think it's a good idea for both members of the couple to wait till 70. Because as you'll see in just a couple of minutes with widow's benefits, once one passes away, the survivors have that one-time check. So why maximize both checks when once one passes away, survivors have that one-time check? So I kind of like the strategy of the one with the lower check taken as soon as possible, the one with the higher check wait as long as possible. That way you maximize the check, the last survivor will draw. She'll get some money coming in the meantime. And I find that I do a lot of personal consultations. And I find that both financially and psychologically, it's easier to have the one with higher benefit wait till 70 to get some money from Social Security in the meantime. You know. So anyway, and it's not always, you know, in general, I think people think of it as too early, but everybody shouldn't wait. There are circumstances where everybody shouldn't wait. This will probably go a lot longer. You've winded money on this question, but for example, I did a consultation really recently with somebody who had a adult child who was disabled at birth. Well, when that person starts drawing their benefits, that child, since they're disabled age 22, that child can draw benefits if they're under age 18. They draw on the record too. And because of that child's disability, the mother had to leave the workforce to take care of him all these years. She still has to take care of him because of disability. So she gets to draw a check too, unreduced. And so between the three of them, if you waited till 70, you'd be passing up almost twice as much a month. It would not make sense, right? That's a 24 years since no money back. So there are circumstances where somebody shouldn't wait. And then longevity works the opposite way sometimes. I was doing a consultation with somebody who had retired at 63. This man, every male in his family had inherited a congenital heart defect. And none of them lived to be 70, not a single one. His parent, his older brothers, his father all passed away in their 60s. His wife was 8 years younger than him. His benefit was much higher than hers. He was wondering, since she retired and would only expect to live about 3 or 4 more years, she'd go and take the benefits now, right? And you'd think, well, maybe he should. However, if he took a reduced benefit, that reduces what the widow would draw when he passed away. Since she's 8 years younger than him and female, she's likely to draw that higher benefit 30, 35 years. I did some computations for him. Had he taken his benefit at 63, reduced for being younger than 40 retirement days, passed away, say, at 67, 68, which is what he expected, he would have cost her over $200,000 in today's dollars and lost benefits by taking that reduced benefit. He didn't have to have the money. He did the proper thing. He did not take those reduced benefits. Sometimes longevity works the opposite way. So you got to really look at each case individually. Any other questions on retirement benefits before I go on to? Yeah.
One other thing about inflation, and I don't know if this is, it comes up periodically or seasonally, the idea that your Social Security can be taken away or privatized or invested in a different fund. We should be fearful of this, but it's meant to be in a good way, because if you put it in a growth fund, it would grow by more and you could have reassurance that the fund wouldn't run out. Can you comment on the idea of it being privatized? Or?
Well, yeah, the George W. Bush. Now, you can't privatize the whole thing because, first of all, you got disability and survivors. And remember, Social Security doesn't do underwriting. You can go to work today, pay the taxes, they're insuring you for disability and survivors, even if you're going to die or you're going to say we're more, right? So that's for almost 1 out of 4 people, they're uninsurable for life or disability insurance because they got previous conditions. Social Security insures them if they work today, right? So you got to pay for that. You got to have a base retirement benefit in case somebody's investment, say somebody was had to retire in 2008, and all the money's in stock fund, that wouldn't be good, right? You got a base benefit to protect them. After they pay for all that under the president's plan, George W. Bush's plan, they'd invest about 2% of their salary. And I said I was actually in favor of it. The reason I was in favor of that is because we middle-class people, we can take advantage of wealth creation because we have money to invest in our 401ks and things like that. And we can take advantage of wealth creation. The low income worker doesn't have that opportunity. Banks don't want their business. Planners don't want their business because they can't make any money on it. They have so little to invest. This gave those people a chance to participate in that wealth creation. I was in favor of it. But Social Security is so popular that when President Bush put that plan forward, about one single congressman or senator would sponsor it, not even his own party. They're so afraid that people wouldn't like it. It's such a popular program. So, that's probably what happened. But you can't, you just can't invest a whole lot into it. And people think, well, I could invest 7.65%. No, you couldn't. You got to pay for disability insurance, survival insurance, and Medicare. And then you do that, plus with protective-based benefit, that leaves about 2% to invest.
Along what he was asking, so the money that's supposedly squirreled away.
It is for what? It's a sacred trust.
Is it invested in something?
U.S. Treasury bonds. In fact, the best of the world.
All bonds.
Yeah, U.S. Treasury bonds. These are good bonds too. Because they, late 80s, $27 million an hour being invested in bonds. What was the interest rate paying in 1986, 87? 18%. So that's some of those bonds are paying 18% still. So that's a good investment. Same investment in the world. That's really the only thing you can invest in trust fund. You can't invest the trust fund itself in the stock market because the government is the regulator too, right? And so if the trust fund, if the trust fund is invested at Ford and GM, and the EPA says we're going to raise emission standards, so she's going to say, no, you can't do that. It's like that's going to hurt our trust fund. So you can't invest in the trust fund itself. The government can't invest in it. That's the definition of socialism, by the way.
Yeah.
So we don't like that in this country. So you can't, trust fund itself can't be invested. George Bush's plan was, but people would decide on their own, they'd invest 2% of their own. But it didn't happen. Not one person in his own party would sponsor it. Okay, spousal benefits. When we're talking about Social Security and say spouses or spousal benefits, that means both members of the couple are still living. The receive benefits on your living spouse's Social Security record, they have to be drawn their benefits first. You have to be at least 62, and you have to not be entitled to more based on your own work. If you've worked enough that you're into a bigger check based on your own work, then you can receive on your spousal record. That's what you get is that higher amount you've earned based on your own work. And when your spouse is living, you always have to take your own retirement benefits first. You can't say, I want to take spousal only and let mine keep growing. Your spouse is living, you always have to take your own first. And when your spouse is living, anything you can receive on their work record is based on half of their unreduced full retirement age amount. So a spousal benefit is based on half. If that wager is deceased, then any benefits they pay the widow on that work record, they call widow's benefits. And when we're talking about Social Security and say widows, that always includes widowers. Exactly the same for men or women. Unlike a spousal benefit, which is based on half, a widow's benefit is based on the full amount of the deceased check if they're drawn Social Security when they passed away, or it's based on their full unreduced amount if they died before they ever drew their benefits. Let's take an example of the most common situation with widow's benefits. Let's say we have a husband and a wife both drawn Social Security. Say the husband's check is $3,000 a month, the wife's is $2,000 a month. If he dies before her, if she is at her full retirement age or older, her check would go up to exactly what his was. In this example, her check would go up to $3,000 a month. If she was younger than her full retirement age when he died, her check would go up to that higher amount. Once again reduced a little bit for each month. She's younger than full retirement age. Widows and widowers can start drawing benefits as early as age 60 on their spouse record. Widows and widowers have an option that does not apply if your spouse is living. Remember, if your spouse is living, you always have to take your own retirement benefits first. That doesn't apply to widows and widowers. They can take whichever benefit they want, whenever they want to, at first, and let the other one keep on growing and switch to it later. For example, let's say we have a widow. If she's working for herself, but her deceased husband's check is higher than hers. So the widow's benefits are higher than her own retirement benefits. Let's say she retires when she's 62. That point, she has the option of taking her own lower benefit, reduced for being younger than full retirement age, receive that until she reaches full retirement age, and then switch over to unreduced widow benefits risk life. Or vice versa, the oldest higher, take the widows first, delay her own. In that case, her own growth till she's 70, those delayed retirement credits. So that applies to anybody here. If you are a widow or widower, you're either unmarried or you do not marry your current spouse to at least 60, because then you can still get the widow's benefits. I strongly encourage you to contact Social Security. Let them give you all your options, dollar figures, and days. They do that all the time with widows and widowers. They say, well, if you take the lower one now, you get this much less per month by doing that right now. But by doing that, when you switch to the higher one later, you get this much more per month for the rest of your life. Give that in dollars to make an informed decision. Bring that back to your planners to help you make the right decision, but get the information Social Security first, you make that informed decision.
There's a number of years though you have to be married, right?
Well, if you were married to the person when they passed away, it's 9 months. If they was divorced, would be 10 years.
Okay.
But if you're married to when they passed away, it's only 9 months. Or if they died of an accident, there's no duration marriage. They're married to it'll be less than 9 months then.
And to get the full benefit of a widow's benefit, I need to be at my retirement.
Yeah,
age,
right.
Not what he would have
His
been.
age doesn't matter, only the widow's age matters, yeah. Right. That's exactly right.
But what if you've been taking his widow's benefit at a reduced rate and then you're at your age, you still get the reduced rate?
Yeah, if you take reduced benefit or any other benefit, spousal, retirement, widows, what you do is a permanent reduction. What you're doing is taking less per month in exchange for more total checks in your lifetime. But it's a permanent reduction, doesn't go up when you reach full retirement age, it goes up with cost of living raises, but you still have that reduction. The same for retirement or spouses or widows, all the same. The reduction, however, on widows benefits is less per month than it is on the others. So a lot of times it's best for the widow to go ahead and, or widower to take. Say you have the widow and her benefit's very low, she might want to go and take the widows at 60, because the reduction is a lot less per month on widows benefits than it is on the retirement benefits. A lot longer. It's 18 years to recover, not 12. It's a lot different in my opinion. Any other questions about spousal widows before I go on to Medicare?
My sister was in her 50s when she passed, but she was married and had two boys who were one was high school and one was in college. So would they be entitled to?
Well, while they're underage, one is under age 18, they draw till they turn 18, or if they're still a full-time high school student at age 18, they can receive till they either turn 19 or graduate from high school.
They're both older now, but her husband, my brother-in-law,
Yeah,
he could.
he almost certainly filed for them and got that benefit, but if one of them was under age 18 anyway, or not, he's still in high
He
school.
could have received it, I guess.
He would have been the payee for them, yeah. The minor can't draw their own checks.
Well, no, I mean for himself, what he has.
Well, he would have had to have a child under 16 in his care for him to be eligible.
Oh,
Also, if he was working, his earnings there's an earnings limit that would apply to his benefits anyway. And he probably would have been making too much money to draw a check, but it wouldn't affect what the child could draw.
I see. Okay, thank you.
Any others?
One more social security related kind of question.
Yeah.
People start drawing on that.
Yeah.
And they decide to start working again afterwards. What's the tax impact of that? So I've read different things where they get taxed.
Well, it's not really a tax. It's just they're not due some benefits.
No,
You pay tax on money you income. This is they're not due. It's not a tax. Tax is something you pay on income you receive.
yeah.
If somebody's affected by the earnings limit, they're not due those benefits. They're not, so they're not entitled to it. It's like somebody who's 59 is not taxed because they can't draw Social Security. They don't meet the requirements. Okay. It's important. I know I'm making a big deal about it. When people call it a tax, it confuses the whole issue. Okay. So that's why I say that. Okay. So if somebody's 40 retirement age or older, there's no limit on their earnings. 67, go to work, make $1 million a day, still draw your Social Security. Okay. If somebody's younger than 40 retirement age, if somebody's younger than 40 retirement age, they limit how much they can make from working.
That's it.
All that counts, that limits what they're actually working for. They don't care about their interest, dividends, royalties, pensions, distributions, and IRAs. That won't affect it at all. Just what they're working for counts for that. There's only two kinds of earned income. Wages from an employer, or your net profit from self-employment, if you're self-employed. That's all it counts for that limit. The limit's not very high, but it goes up with inflation. This year it's $24,480, $24,480. So say you have a 63-year-old goes to work, takes a part-time job. He doesn't earn more than $24,480 from that job this year. His benefits are not affected at all. If he earns above that, for every $2 he earns above the limit, $1 for health benefits. So if he made $26,480, exactly $2,000 above the limit, they're total $1,000. One for every two he's above it. They rest the benefits for the year. What somebody, no matter when they start drawing benefits, once they're full retirement age, no limit from then on. And there's a special for the first year a person retires. The first year a person retires, they can receive a check for each month they're not working, no matter how much they made before they retired that year. Let's say somebody's going to retire September 30th of this year. They're not be working October, November, December. No matter how much they make, January through September, they can draw a check for October, November, December because they're not working those months. Especially when somebody retired during a year and go ahead and start their checks up. It only applies in that 1 year though, that first year retirement. After that, they just look at the yearly amount. Any others? Okay, Medicare. And between the two programs, Medicare, in my opinion, is far more important than Social Security. Because Medicare gives us something we simply cannot get anywhere else. And that's health care insurance that pays first, once we're 65 and over and retired. When we are 65 and over, we are uninsured. You cannot expect private insurance companies to sell us health insurance that pays first at that point at a price we can afford. Because if they had to do that, there'd be no more private insurance companies. They'd all be bankrupt. So when we're uninsured by the tens of millions, only the government can insure us. And that's what Medicare is. So what Medicare means is we still have access to health care after age 65. You can't put a dollar figure on that. That's worth more than money. And between the two programs, Medicare is far more complicated. And so it's and especially nowadays, as more people working past 65, like we mentioned, it becomes very complicated, and it's very important to get it right. And that's mostly including what we're talking about Medicare Part B. I'll talk about what that is in a minute. First of all, Medicare's age is still 65 for everybody, not gone up. Also, people get disability from Social Security after 2 years, they get Medicare. The two basic parts of Medicare are Medicare Part A, Medicare Part B. Part A is the hospital insurance part of Medicare. It pays the hospital bill itself when we're in the hospital. People say Part A is free. It's not free. It's a matter of when we pay for it. We pay for Part A while we're working, so we don't have to pay for that once we are retired. If you're working right now, look at your pay stub. You'll see that FICA tax is divided into two parts: 6.2% Social Security, 1.45% Medicare. That 1.45% we pay the FICA tax. That's what funds Part A. So we pay for Part A while we're working. We don't have to pay for that once we are retired. So as long as somebody qualifies for Social Security based on their own work or the spouse's work, even not draw those checks yet, Part A won't cost them anything once they're 65 and over and retired. But Part A is just going to pay the hospital bill itself when we're in the hospital. So doctor bills and outpatient treatment, those are paid for by Part B. Now, Part B does have a cost. So we're not, now, not say Part B covers doctor bills, that's all doctor bills. If you've been in the hospital recently, you know, when you get out, you get the hospital bill in the mail. Then you get bills from all the doctors you saw in the hospital. Then here come bills from doctors you didn't even see. Since those are doctor bills, Part A does not cover those. Those are paid for by Part B. So Part B covers all doctor bills in and out of the hospital and outpatient treatment. It's an important part here. The important thing I talk about is right here. Part B does have a cost. It's got a monthly premium, which this year is $202 a month. They just hold that out of your Social Security check each month. Or if you're not taking Social Security yet, there's different ways you can pay for it till you start your checks up and get out your checks. Since Part B has that cost, it is a free country. You do have the legal right to turn down Part B. You don't write that down till you hit the flip side of that coin. The flip side of that coin is it is a free country. You do have the legal right to bankrupt yourself. Now, there is a time you absolutely don't want to take Part B, and I'll talk about that in detail in a minute. But once Medicare is your primary payer, once Medicare's paid first, which pretty much once you retired from where you have your health insurance, or 65-year-old. Once Medicare's paying first, if you don't take Part B at that point, you just made the biggest financial mistake of your life. That's a mistake that's almost guaranteed to bankrupt you if you get sick before you get your Part B back in place. A lot of reasons you want to make sure you have your Part B in place. Once Medicare is your primary payer. I'll talk in detail about when Medicare is not primary in just a few minutes. Number one, $202 a month's got to be a great deal, right? Anybody here want to start an insurance company and insure people for doctor bills and make 65 to 100 or whatever for $202 a month? Of course not. That's only 1/4 the cost of Part B's premium. The federal government pays the other 3/4. So every month somebody pays $202 for the Part B. That same one person, that same 1 month, they're going to pay $606 for the Part B. We pay 1/4, the government pays 3/4. Now, if somebody has income above $109,000 for an individual or $218,000 for a couple, they don't get the full 75% subsidy from the government, so they pay more than 1/4 the cost. How much more they pay depends on how much income's above $109,000 individual or $218,000 for a couple. But here's the issue. Social Security has no idea how much income somebody has this year, how much they had last year. You have to base that higher premium always on income 2 years before. So here in 2026, that higher premium for Part B is based on somebody's 2024 income. From January 2027, it's based on 25 income. Still, we're always 2 years before. But if somebody's income has gone down since 2 years ago, for certain reasons called life-changing events, they can ask to base that premium on the current income, not what they had 2 years ago. The most common life-changing event is retirement. If you just found some good job, you retire, you file for your Part B, and then you get a letter saying based on your income 2 years ago, it's part of this high premium, then be sure to let them know your income went down because of retirement, because they don't let you tell them. Just the fact that your income is less than it was 2 years ago does not necessarily mean you have to pay a higher premium if they've gone down for one of those life-changing events. The second most common life-changing event is becoming widowed or changing marital status in general. You do widowed because of the birth rate. If someone went down because of that 2 years ago, you should let them know. There are a few other life-changing events that don't apply very often, but they list all the possible ones that that literally sends you. Your income's gone down since 2 years before, either of those reasons, just be sure to let them know. And be very careful in the future. Talk to your planners here. If you're gonna maybe have a capital gains 1 year, sell some property, maybe have a capital gains 1 year, or take some deferred money out of your 401k or IRA or something like that. Make sure you try to not take too much out and have to pay a higher premium, because people get surprised. So take a lot of deferred money out this year. 2 years later, they're surprised for 12 months to pay a higher premium. Or they'll have a sales department going to be capital gain this year. So maybe you want to spread it over 2 years, 2 calendar years or something, so you don't go that limit. And just be careful in the future. Any questions about that?
Well, I'll just make a comment.
Yeah, big thing.
Plan ahead a lot on that topic, and we call them nastygrams, that FIRMA letter,
Yeah,
all caps IR and his name.
right.
So we spend a lot of time in that area,
Good deal.
preempting the nastygram, the potential of the nastygram, or at least we're having a conversation, we know we're gonna have Medicare surtax, but at least you know why.
Yeah, absolutely. Absolutely.
When you talk about the HSA and you
I'm
can't.
going to talk about that, yeah.
Next up.
Okay, second reason we want to make sure you have Part B in place once Medicare's primary. Is once Medicare is your primary payer, Medicare's paying first, nobody in the world will pay anything Medicare pays for except Medicare. If you don't take Part B of Medicare, when Medicare's your primary payer, if you don't take Part B, you just made yourself Medicare. Because you pay all the doctors out of your pocket to get your Part B back. That can be a lot of money in a very short period of time. You'd be amazed how many people I talk to that tell me that for themselves or their mother or father, that in 1 year, for one person, Medicare paid more than $2 million in hospital and doctor bills. Usually over half that's doctor bills, is what Part B paid. If you didn't have a Part B in place, that's $7 million bill. I know somebody that Medicare Part B paid $330,000 in 7 days. So you want to make sure when Medicare's your primary payer, you have your Part B in place. So the reason you want to make sure you have your Part B in place, once Medicare's your primary payer, is you don't take Part B at that point, then this person realizes, oh, I made a big mistake. I'm gonna run down this Social Security, get my Part B back. When they get down to that office, they got some good news for them down there, and they got some bad news. The good news is, yes, they can get their Part B, if they didn't take it when they should have, they can get it. The bad, usually can't get it back today. If someone does not take Medicare Part B, when Medicare becomes their primary payer, to get it, they have to wait till the first 3 months of a later year to even reapply for it. It'll start the month after they apply, and that premium will be 10% higher for the rest of their life. Each year they should have had Part B and did. Reason that law is that law wasn't in place. Some people take Part B and pay for it when they were sick, then thought when they got well, when they got sick again. You're not having to pay your auto insurance premium just a month you have an accident, not pay any other time. Wouldn't be insurance any longer, that would drive the cost up to nobody could afford month worth of cost of it. But the danger is not that they have to pay a little more the rest of their life. The danger, they got sick last July, can't get the Part B till February 1st, they got $1 million in doctor bills, right? Now, the only exception, the only time you don't need Part B, that's what's coming up right now. The only time Medicare is not your primary payer is this. When you turn 65, if you're still working for an employer of 20 or more employees, covered by that employer's health insurance as an active employee, then while you're still working past 65 for that employer and keeping that health insurance, Medicare pays second, the employer's group insurance has to pay first. Medicare is not forced you to pay for Part B as secondary coverage. So if you're still working for an employer of 20 or more employees past 65, covered by their health insurance as an active employee, you can wait until you retire, get something called a special enrollment period to file for Part B. It'll start right away. There'll be no penalty. Works for your spouse too. Say that you're working for an employer of 21 employees, got their active employees health insurance, got your spouse on that insurance, and your spouse turns 65. That's the same as them working down there. Medicare would be secondary for your spouse until you retire. They get that same special enrollment period, you retire to get their Part B in place and start right away. No penalty. Talk about that in a little more detail. So Medicare secondary, because this person is covered by the other spouse's active employment for employed 20 more employees. Should they take Part B of Medicare secondary? Should they take Part A of Medicare secondary? Let's take Part A. Person might, and I say might, want to take Part A in that situation. It does not cost them anything. They have secondary coverage on a hospital inpatient stay. The insurance pay first on that hospital bill, Medicare Part A pays second. But the one situation when Medicare is second that you might not want to take Part A, that's if you have something called an HSA and you want to keep putting money in that HSA. Now, HSA is a health savings account. Not your flexible spending you lose at the end of the year. It's not that. To have an HSA, you have to have a high deductible health plan. You get to put tax-free money in that HSA and you don't lose at the end of the year. The law says you cannot put any more money in an HSA once you are entitled to any part of Medicare. So if you're working past 65 like that with Medicare secondary, you want to keep putting money in the HSA, then don't take Part A till you retire. Let's talk about the timing of that. Because Medicare law was written way back in 1964, 1965. That was decades before the law established HSAs. Sometimes when that happens, the laws don't stick together perfectly and they don't here. The original Medicare law that still applies states that if someone does not take Medicare Part A at age 65, then when they do file for either Social Security or Medicare Part A later, their Part A will start 6 months retroactive. It'll start 6 months before the month they made that application. That's the law. Social Security can't stop that from happening. So if you work past 65 with Medicare secondary, you don't take Part A because you want to keep putting money in the HSA. You can stop those HSA contributions 7 months before you're going to apply for the Social Security or Medicare Part A, because it's going to start 6 months retroactive. Law also says anybody 65 or over drawing Social Security automatically has Part A. They can't turn it down. And so, in the first 6 months, one month they made that application. Any questions about that?
I have a question.
Yeah.
So if I turn 65 this year, and so that means I need to sign up for A, and do I need to start like, you know, when you go to the doctor and they say, do you have another insurance? Am I supposed
Are you still working?
Yeah,
For the employer, 21 employees, right?
yes.
And you don't have their health insurance.
Well, I have health insurance, I'm working full time,
Okay.
like 100.
You don't have to do anything
Okay,
with Medicare secondary, but if you don't have an HSA, you might as well take Part A. Because it doesn't cost you anything, that's secondary coverage.
am I required though to sign up?
No, you don't do anything for your retire.
It's automatic?
That's not automatic, it's just you don't have to do anything.
Okay,
Whenever you can start with Part A anytime you want to.
okay,
And you get a chance to take Part B when you retire, and we talk about that. But if you don't have an HSA, you might as well take Part A. because it doesn't cost you anything. If you're in the hospital, it would pay secondary to your employer's insurance on that hospital.
Oh, okay,
I
so,
picked up the deductible the core insurance is.
so it would pay the, like, if it's 100.
It might, yeah. It's got a deductible too, but it depends on everything, but yeah, but it might. Like, it might pay some of that out of like
So
constant.
why did I just sign up for them?
And you can sign up for, you can sign,
It's like not. do it.
no, not in that situation. You can take it anytime you want to. But you might, if you don't have an HSA, you might as well take it.
Yeah,
Doesn't cost you anything.
and then the B,
We have a fee now, yeah.
when you have to sign up for them.
We'll do that, that's the next step. That's the
Okay,
next
great.
step.
Thank you.
Yeah.
And just to clarify, you can have the HSA, you just can't keep contributing to it.
Right, that's right. You don't lose it.
8 months before, fully fund it, and then stop funding it. And then you have that 7 months.
Yeah, yeah, right. Or that's what happens sometimes. If it's within the calendar year, let's say somebody didn't know that long. They applied in December for Social Security. And before the HSA has been reported to IRS, because not, the year hadn't come yet, and they realized, oh, Medicare started in June. And they can go to the employer, to HR and say, back those contributions out the last 6 months.
Is that a pro rata basis for the?
Yeah, the employers don't have to do it. I don't know, I'm not a tax expert.
Okay.
If the employer, the HR department have to do it, because I've never seen a problem with it. But now, the problem arises that if the 6 months went back in the previous year, they already filed their tax return.
Yeah.
They haven't filed the tax return,
Yeah.
because it goes a lot more money. People actually, they'll say, well, what happens if I don't, if I keep putting money in HSA after I have Medicare in place, Medicare Part A in place? Well, about 2 years later, they're gonna go back to the mailbox, there'll be a letter in there, up in the corner, it says IRS, right? Nobody wants to get that kind of mail. So Part B, so the situation, once again, Medicare secondary, because this person's covered by their other spouse's active employment to employ 20 more employees, Medicare secondary. Should they take Part B of Medicare secondary? And the answer is almost certainly not. And this is why. I'm sure you're aware that not just pensions have disappeared, but also retirees' health insurance from employers has just about disappeared too. 30 years ago, big corporations almost all let their retirees keep health insurance when they retired. They got to keep it past 65 to pay secondary to Medicare. That's just about disappeared. For the same reason, people are living longer in retirement. So can't afford that anymore. So somebody working past 65 like that, when they retire, their employer's health insurance stops. Medicare becomes their primary payer, and they're probably going to want to buy something called, and I'll talk about this more detail, something called a Medigap insurance policy, also called a Medicare supplement. To help pay you about 20% Medicare doesn't pay in hospital doctor bills. So you're buying this from an insurance company. Insurance companies like to sell health insurance to who? Healthy people, that's right. They don't like to sell health insurance to people that are already sick. But federal law has to protect the rest of individuals. What the law says is, you go to an insurance company, you tell them, I want to buy your Medigap policy. At that point, you have been entitled to Medicare Part B for less than 6 months. You have what is called a guaranteed issue right. They cannot turn you down or charge you a penny more, no matter how sick you might be. But if you wait, if you've had Part B for less more than 6 months, you go to buy it, they can turn you down or charge you whatever they want. Just take an example, somebody might be tempted to go ahead and take Part B and pay for it in Medicare secondary. This person we're talking about, still working for an employer, 20 more employees, covered by the health insurance, but even though they're still an active employee, they got a serious illness. And they have to go to the doctor or for medical treatment 2 or 3 times a week. And every time they go, they got a big copay on their employer's insurance. Adds up to be a whole lot of out-of-pocket costs every month. That person turns 65, they might be tempted to say, I ought to take Part B. It might pick up a lot of those out-of-pocket costs I'm paying as secondary coverage, and it might. Here's the danger. Let's say that person took Part B at age 65 in Medicare secondary, to have that coverage. 3 years later, at age 68, they retire. Lose their employer's health insurance. They've had Part B for more than 6 months, haven't they? They've had it for 3 years. They retire, go to the insurance company, they're going to be either turned down or charged more because they're already sick. We had the way to take Part B in that special enrollment period when they retired, they would have had it for less than 6 months. They couldn't be turned down or charged a penny more, no matter how sick they might be. That guaranteed issue right is a very valuable thing. You don't want to waste it when you don't need it. That person didn't need that coverage when she was still working in close health insurance. She needed it when she retired and lost that coverage, right? That's why I don't want to take Part B when Medicare is secondary payer. Any questions about that? Last thing, you do want secondary coverage in Medicare. You absolutely do. Because Medicare pays about 80% of the hospital and doctor bills, like a lot of insurance. But the issue is, as we get older, that total bill gets higher. That 20% Medicare doesn't pay can be a whole lot of money. You know, I told you Medicare, I talk to people all the time, Medicare pays over $2 million in 1 year for one person. That's a lot of money Medicare paid, but that was 80%. That means it didn't pay over $400,000 in 1 year, right? We hear planners, that's probably pocket change to you, but it's a lot of money to me, okay? So you want to make sure protect that kind of catastrophic event. So you have three ways to control your out-of-pocket costs. You may still work for an employer that still offers retiree health insurance. You may. You know, you may be a government employee. They're about the only ones that have it, except the only kinds of employers I still see, the private employers still offer retiree health insurance, are some insurance companies and some oil companies. So you know who makes the money. So you being in Houston, you may happen to work for an oil company that still offers retiree health insurance, but most people only have that option. So if you don't have that option, your employer doesn't offer retiree health insurance. You have two other ways to limit your exposure to out-of-pocket costs. You can say original Medicare, which means there's no network. You can go to any doctor except Medicare anytime you choose. When you do that, you buy something called that Medigap insurance, like the insurance company don't pay what Medicare does. The other option, you join something called a Medicare Advantage plan. It's like a Medicare HMO. If you join a Medicare Advantage plan, Medicare pays that plan a lot of money to give you all your Medicare services. The way that limits your exposure to out-of-pocket cost is in the Medicare Advantage plan, you pay the same copay for a hospital stay or a doctor visit. With that visit cost $10, $10,000, you pay the same copay. But you have to stay within their network or their doctors or hospitals. If you're going to ask me, I prefer original Medicare by Medigap policy. And I'll tell you why. Houston is one of my favorite cities. I never lived here. Houston is one of my favorite cities, and I'll tell you why. Because you got MD Anderson here in Houston. Okay. My wife is cancer-free now. But for 2 years, she fought cancer at MD Anderson. The day she's died, we're over 65. The day she's diagnosed, we called up MD Anderson. Because if you're a 4-hour drive away from the best place in the world to be, that's where you need to go. That's our opinion. That's about how long it's about 4-hour drive. MD Anderson drive from us. And one of the first things they asked her was, are you in a Medicare Advantage plan? Because at that time, anyway, no Medicare Advantage plan included MD Anderson on that work. If you've been Medicare Advantage, you couldn't have gone to MD Anderson. With original Medicare, by Medigap policy, you can go to MD Anderson, you can go to Mayo Clinic, go to the Cleveland Clinic, be welcome with open arms. Might not have those options in Medicare Advantage. And you can afford to buy a Medicare supplement. Now, let's talk about if you do stay at the original Medicare, let's talk about that Medigap policy you're going to want to buy. Because an insurance company does not make up their own Medigap policies. The federal government has standardized plans. So Medicare has parts, Part A, Part B. These Medigap policies are plans. Every insurance company Medigap plan A is exactly the same as far as coverage. The price might vary, but the coverage is exactly the same because it's set by federal law. Trust me, if you go with original Medicare, Medigap policy, the one you're going to want to buy is Medigap Plan G, cheap or good. Medigap Plan G, cheap or good. If somebody had Medigap Plan G this year, the most to be out of pocket for hospital and doctor bills for the whole year, no matter what, is $283 a month. $283 total for the whole year, $283. What I tell people is, when you're 65, or if you work past 65 and you retire, don't buy the Medigap policy you want then, buy the one you're going to want when you're 90. That's Medigap Plan G. Because an insurance company won't let you buy a cheaper plan when you're 65, then at 80 switch over to Medigap Plan G. And I wouldn't either if I was. You figure they make the profit on the younger of the over 65, right? They don't make much profit until somebody's 85 years old. They probably lose money on that. And so I'm going to use my mother, for example. I told you she was 94, and she's doing great. But I find, not just with her, but other people I've known, when we reach that advanced age, late 80s, something changes in our brain chemistry. We become anxious about a lot of things that never bothered us before. My mother never worried about anything. She worries about stuff. She's anxious. Nobody won't be out more than $283 just for the whole year. The hospital doctor bills is one less thing to be anxious about. So by the one, when Medicare becomes your primary payer, you're going to want when you're 90, and trust me, that's Medigap Plan G, cheap or good. And they don't cost a whole lot more than the ones that don't pay as much. And you know, people People get some really good deals. They tell people, call us, got to tell me how much they're paying for their Medigap plans. Some people tell you they're getting Medigap plan GA65 for 130 a month. It's a good deal. So trust me, that's what you're gonna want. If you do decide to go with Medicare Advantage, then you're gonna want to pick the one that's best for you. And so with Medicare Advantage in a big metro area like this, you probably have at least 40 different Medicare Advantage plans to choose from. Last count I saw for Houston was 44, I think. And the best one for you might not be the best one for your spouse. If you decide to go with Medicare Advantage, against my advice, if you go with Medicare Advantage, you want to pick the one that's best for you. You can go on Medicare's website, because Social Security only does the entitlement part of Medicare. They don't know all this stuff. So Medicare has something called a Plan Finder on the Medicare.gov, Medicare.gov on the website. Go to Plan Finder and say, help me pick my best Medicare Advantage plan. I'll ask you a bunch of questions, show you the best one. And then Medicare Part D, for D like drugs, D like dog, for prescription medications. If you go with the original Medicare, then you're going to pick something called a standalone Part D plan, standalone Part D, to help you cover your medications. And very important, the best Medicare Part D plan for you is probably not the best one for your spouse, unless your medications are exactly the same. And so there's two ways you can pick your best Part D plan or Medicare Advantage plan, same thing. If you go to Medicare.gov, go to Plan Finder for standalone Part D plan, look at medications you're taking, show you the best ones that cover those medications, or use the pros. Medicare doesn't have offices everywhere like Social Security does. So what they've done is they train people to look at nonprofit agencies and all the Medicare health insurance rules. I used to help train on Social Security, they're very well trained. They set them out there and pay their salaries at these nonprofit agencies. Right, no cost to us helping Medicare planning. And so if you contact that, whoever they are in your area, I've dialed 211. Everybody knows what 911 is? 211 has been around about 20 years now, but people still aren't much aware of it. It's not a Medicare number, it's for any social service information. So when the time comes, just dial 211, say, I want help with Medicare planning. They can help you pick your best Medicare Part D plan. And best means the one's the least amount of out-of-pocket cost. If you're taking a very expensive medication, the cheapest plan overall might have a higher monthly premium because the medication is better than anybody else does. That takes all that into account to find the best plan. You can change plans once a year. If you're in a Medicare Part D standalone plan, you can change it once a year. Just take you pick a best plan right now based on what you're taking. And then 5 years from now, your doctor prescribes a brand new, very expensive name brand medication. Contact the same people again and say, I'm taking new medication. Every fall, you can change plans for the next year. So in the autumn of that year, you contact them and say, we pick my best plan for next year. And anytime you want to, we change plans once a year.
Well, and to build on that, because the formulas change every year, we try to be very active. With
Oh, good, good, okay.
Saying you have to check because inevitably every couple of years someone will call us in and they'll get surprised with bringing one up or something's not covered.
Yeah.
Because they change the formularies.
Absolutely. So yeah, if you're going to change it, take it every year, that's the best thing by far. Yeah, absolutely. Absolutely. You know, the Part D set up for you to be proactive to make sure you're in the best plan. And when Part D first started, that's what I found out when Part D first started is the couple, the wife picked a plan based on the name she trusted and made the husband pick the same plan, which means they weren't buying the best plans based on what they were taking, right? They were paying more than they should have for the medications. And then Part D got a lot better based on the Inflation Reduction Act passed a couple of years ago. As long as your drugs are covered by your Part D plan, you won't be out more than $2,000 out of pocket for your drugs for the whole year, no matter what. So it got a lot better. There's no more donut holes, a lot of stuff. That's all gone. You have a $2,000 out of pocket maximum. So just make sure your drugs are covered by your Part D plan, and then we'll be out more than $2,000. Yeah.
Talk about all these, what's it called, the people that you can call and they'll help you with whatever plan you want, but they're independent.
Brokers.
Yeah,
Yeah. I mean, if you want to use them, that's fine because you don't pay them anything.
No.
So
How do they get
they draw a commission from the insurance company that you choose.
That's what I think.
Yeah. But you can use these people I mentioned because they're for straight salary. They pay straight salary. The one thing about brokers is the Medicare Advantage plans pays them a bigger commission than the Medigap plans. They gotta be careful about that. So,
And these people that you have, it's like you said.
yeah, pay straight salary. Their only job is to make sure they get you the best plan.
If a company offers the Medicare supplement as part of retirement,
Yeah,
there's a concern that they have a problem managing their plan and say they cancel it. Is that a reason?
that gives you a new time to buy a Medigap plan without being turned down. So if you lose your secondary coverage to Medicare, lose your primary, it's not non-applied, but if you lose your secondary coverage to Medicare,
Medicare supplement. So Plan F, Plan G.
you can, employers actually offering a Medigap.
That's right.
Okay, well then
Medicare supplement.
you couldn't lose that unless you don't pay the premium. Maybe the cut, because you're,
I'll give you two examples.
Uh-huh.
There's a public company I'm aware of that offers a like Plan G
right,
through them.
right.
But a few years ago, they decided everybody had to go on advance. And then there's an oil company here that did the same thing about 2 years ago. And I worked at we're under company with that. And I'm concerned about that.
I believe you'd have the right to say, I want to stay, go be with objective as a company offering that. Medigap policies now just want to stay with you, the individual policy holder. Yeah, I'm sure you'd have that right to do that, because that's not actually employer's health insurance. Just employer just negotiated a group rate. Your premium might go up because it's no longer a group rate, right? But you,
Also, we've been wondering, if we'd be better off talking to a 211 person and finding out if.
I would,
Okay.
yeah. Because first of all, they're local, so it'd be a work situation almost certainly already. But secondly, an employer, some employers have negotiated a better Medicare Advantage plan than the general public can buy.
Right.
And so
And at the time.
sometimes if an employer is offering a Medicare Advantage plan, they may have negotiated a better one than you and I can buy on the open market. And that might let you go to MDS. That's what I would ask them. What about out of network? What about out of network? And so, for example, Teachers Retirement of Texas, they're retirees. It's a Medicare Advantage plan, but it's better for out of network than the original, than most of them are. And so an employer's Medicare Advantage might be better than what we're talking about. Might give you those options. That would be something to ask them.
That is the concern.
Yeah, but that'd be something I would ask them. What about out of network? Could I go anywhere I wanted to? And how much would you pay if I did? That's a question to ask them.
One of the concerns for a lot of people is deficit spending in our country and how much we spend. And
Yeah.
if you factor in Social Security and Medicare, it's like between 50 and 55% of this.
That's not part of the deficit though. They never borrowed a month down from anybody. So let's get Medicare totally self-sufficient. There's no, it's all paid for out of the trust funds. There's no zero fund money going into that. That's not part of the deficit. That's actually bringing the deficit down. And well, recently when they started. But the deficit always looked smaller in the past because they'd use Social Security surplus in their trust fund to offset the deficit spending to make it look like that. The deficit's not part of, Social Security's not part of the deficit. There's no zero fund going into that. It's trust fund money paid for it.
Because it's all separated.
Yeah, foresee some of the prescriptions to go down with some of the initiatives, this administration.
I don't take side of the pockets. I can't see that they've done anything that would make them go in.
The prescriptions,
Yeah, I know.
that Part D wouldn't benefit from some prescription cost reductions.
Haven't it gone down is what I would ask you. Can you point out one that's gone down?
Yeah.
Yeah. So far, I don't know, but.
I will say the improvement coming a couple of years ago were good.
Yeah, before the Affordable Care Act got that $2,000 out of pocket
Yeah.
maximum in there. So Part D is much better now than it used to be because you no longer have a donut hole and all that. Actually, Medicare people kind of shielded from the cost of prescription now because under Part D, as long as your medications are covered by your plan, you won't be out more than $2,000 per year without cost. We're kind of shielded now from those. It really applies now to working people more than they have to be concerned about the Medicare drug costs rather than Medicare people now because of that new law. That's all I have prepared for. Any other questions? Going back to Social Security, anything I didn't talk about? Yes.
I have a Medicare question.
Yeah.
You touched on this and I was a little confused on it. I do have a company where they offer the retiree medical benefits if
Okay.
you want them.
It's a private company?
Yes,
Okay, don't mind me asking, who is it?
it's Fox.
Okay.
So they offer it as an option. I guess, I think it's kind of based on how long you work there.
Yeah.
Which I've been there
Also,
forever and I
yeah.
still have the retirement package. I got in
Yeah.
you know,
Right.
when I was a baby. We were both babies.
Yeah,
And, yeah, so how do you know, like, what do you do with it? Where does that fall? Is that in
well, and
lieu of Medigap or?
yeah,
How do
right.
you know
It
what
would be
you
kind
got?
of like a Medigap policy. It would help pay, if you get to keep it into retirement past 65, then I can't say exactly what's gonna cover, because they all vary, but it'll be like a Medigap policy kind of help pick up those out-of-pocket costs that Medicare doesn't
So
cover.
that's instead of the Medigap. So you'd have to
Right.
weigh which is better, what they're offering or what Medigap.
Yeah,
is.
yeah. Now, most employers that offer that, they're negotiating group rates for the retirees, so usually it's better than what you could buy, either better or cheaper than what you could buy
From Medigap.
Medigap. But some employers, like I say, they offer that, but they charge you so much, nobody takes it.
Yeah,
But then most companies would do that, but some do it. But if they're not doing that, then it's something, that's something to look at first. Look at first to see if that's better than Medigap. And then if you happen to lose that in the future, as we just said, you'd have another guaranteed issue right then to buy a Medigap policy.
Oh.
What's that in the future?
even if I was already,
If you're 80 years old and they drop it,
then I.
you can go buy a
Well,
Medigap
then you
policy.
still get that mandatory, like I.
they'd have to sell it to you without charging extra. Yeah, that's another guaranteed issue,
And then
right?
you said the there's choices of which one.
Yeah.
you take,
Standardized plans, Medigap Plan A, Medigap Plan B, C, a bunch of them.
And how do you?
G's the one you want.
G.
Yeah, G. G will
But
get.
is there only one Medigap G? Like if you want Medigap G, then that's the way.
Yeah, every insurance company, because they're standardized plans, every company's Medigap G is exactly the same thing as far as coverage.
You just sign up and it's.
You price shop. One might be cheaper than another,
But it's the same.
but the same, yeah,
So it doesn't matter which,
yeah, it doesn't matter because they're all set by the standardized plans, so buy the one that's gonna give you the best deal.
and everybody has to take it or. Like doctors, like you were
Yeah,
talking
well-
about MD Anderson. and stuff.
Yeah, right, hardly some doctors don't take Medicare, but they're very few and far between these days because there's so many of us baby boomers. Doctors don't accept Medicare now, losing 15,000 patients a day. There's 15,000 people every day turn 65. I was predicting this would happen for a long time. It's happening now. I was doing a seminar recently in Dallas. This woman said she had a doctor on North Central, cardiologist. And she got a letter from him when she was 64 and a half saying, you gotta find another doctor because they don't accept Medicare. She wrote him back a letter, said, do you ever look at the age of the people in your waiting room? You're not gonna need patients in the future. Could it have occurred to them? Because 2 weeks later, she got another letter saying, please stay with us if you are not accepting Medicare.
That's hilarious.
Any others? Any others? Well, thank you very much for your attention. Thanks for having me out here. Yeah, appreciate it.
All right, so thank you all for coming. You can see the desserts are to go. I was gonna say, you can stay as long as you like. If you like coffee, we can find a reason for coffee.
Where's the plastic board?
Thanks again.